These are 3 South African stocks that you should completely avoid going into 2023. It's difficult to find great companies to invest in, and there's a certain amount of stuff that we need to look at to determine whether it's a good investment. Even more difficult is knowing which stocks to avoid. We don't want to be caught in investments where you lose all of your hard-earned money. In this video, I'll share 3 companies to completely avoid in 2023. I'll share a few basic stuff that we can use to determine whether a company is a bad investment. This just means we can quickly analyze that company. We can look at these metrics and we'll know this is not a good investment. Although I can be completely wrong with the stocks that I'm going to mention, personally I feel that you can probably still make money with them. But in my opinion, it is complete speculation. Speculation meaning it's like gambling. I don't like to gamble with my investments. I like to take calculated risks and stay away from the risky stocks and lose out on the magical returns that it might give you, but I'll rather play it safe and invest in quality companies that I can hold for the long term. This is not financial advice, and take everything that I'm sharing with you with a grain of salt. Use the information and go and do your own research. So the first company that we should avoid and really stay away from is Steinhoff International. You might have heard about Steinhoff before because of all the drama that it has caused in South Africa. There's quite a lot of people that got burnt with this investment, and unfortunately there's still people that thinks it's a good investment. Again, I feel that the stuff that I'm going to show you is a red flag and a clear indication that it is not a good investment. Your opinion might be a bit different, so feel free to let me know whether you are someone that believes one of these companies are a good investment. So I'll jump to my screen, and if you haven't heard of Steinhoff before, Steinhoff is a multinational holding company that is listed in Germany and South Africa. If you haven't yet, check out the Showmax series called Steinheist, which is quite interesting to kind of figure out what has happened. Steinhoff is a retail company which specializes in furniture and household goods. Unfortunately, in 2017, the shit hit the fan, and there was some fraudulent activity that took place within the company, meaning that they cooked their financial statements, and that caused quite a lot of problems. With that out of the way, I'm going to show you guys quickly why I feel that Steinhoff is not a good investment at all. I'm going to jump to their financial statements and quickly jump to their cash flow statement. This is my favorite statement because this is where you can see where the cash is going. First of all, we can see that quarterly Steinhoff is losing quite a lot of money. So we can see at the bottom that Steinhoff lost 1.5 billion euros in the latest quarter. This means that Steinhoff is losing around 680 million euros per quarter. How we get to this number is deducting our 1.5 billion euros with the previous month's free cash flow. That equals 608 million euros. So if the company continues losing this amount of money, they will run into a lot of problems within around 22 months. This means that the company needs to take on more debt to pay off its current operating costs. Another thing that I quickly want to show you is the company's gross margin. Gross margin is the company's gross profit relative to its revenue as a percentage. If this value is negative, that means that the company is obviously not generating any positive gross profit. And that's obviously not a good indication. And this is something that is very interesting because Steinhoff's gross margin is 40%, which is around average. But the important thing to look at is that its net margin is minus 9.2%. Net margin is the net income or earnings margin for a business. It shows how much of the revenue it's converted into earnings. This means that the company is losing money from its operations. So the question is, how long can a company like this continue to lose millions and millions every quarter and still give back to its shareholders or their investors like us? The answer is they can't. We can see that the financial health of the company is really bad. The growth seems like it's amazing because it is growing its revenue and it's growing its gross profit. But again, its operating cash flow is decreasing with a massive 500% every quarter. This is a total red flag. Again, its profitability is basically next to nothing. It's losing so much money each and every quarter that it needs to take on more and more debt, and eventually the company is not going to be able to take on any more debt. While we are talking about the debt, I really just want to show you something very scary, and this is going to be a graph of the company's total assets versus its total liabilities. And this shows that the company is insolvent at the moment, meaning if something should happen, the company has more liabilities than assets, and this will result in the investors and shareholders losing a lot of money and basically not even getting a cent. Currently, the company's assets is around 26 billion euros, but the liabilities is around 35.8 billion euros. This is a clear indication that the company is not very sufficient. So let me know down in the comments if you feel that Steinhoff is a good investment or not. Like I said, I'll be honest, I might be completely wrong, but the stuff that we just looked at is a pretty clear indication. A lot of times people think investing in a company with a share price that is low means that the company is cheap or it's trading below its intrinsic value. This is simply not the case because there's a reason why the company is trading that low. The share price by itself does not indicate whether it's a good investment or not. The next company that we should completely avoid, in my opinion, is Avenge Limited. We'll jump to the company's financials, and again, this company has a gross margin of 8%. This is again a very low gross margin, and ultimately it means that their net margin is 0.59% in the latest quarter. If we take a step back and look at all of the previous quarters, there hasn't been a quarter in the last 10 years where the company had a net margin above 8%. This is not great because it means that the operating business of the company is not really generating a lot of money. If we go to the company's metrics, we can see that the current ratio is 1.14. And the current ratio is a popular metric investors use to compare the current assets and its current liabilities. A current ratio above 1 means the company has more current assets than its current liabilities. And obviously, the higher it goes, the better it is. So 1.14 is cutting it really close. And then something else we should have a look at again is the cash flow statement. If we scroll to the bottom, we can see that the company is really struggling to generate any free cash flow. Free cash flow is where we can determine whether a company's operation is generating enough cash so that there's cash left over after that quarter or after that year. If a company can't generate enough free cash flow, it means that they don't have a very profitable business. We do not want to invest in companies that is not very profitable. So that is something to keep in mind with Avenge. Avenge is an international infrastructure and resource company, and they mainly operate in steel and engineering. This is definitely a tough business to operate in. Just to put this into perspective, if we have a look at the company's net margin, it's currently trading at 0.5%, which means for everything they sell and everything they do as a company, company, they get to keep around 0.5% of that money. That should be a clear indication that it is not a good company to invest in at the moment. The highest the company's net margin has been since 2008 has been around 5%. Then lastly, we are going to look at PPC Limited, which is a cement and lime supplier in Southern Africa. PPC just overall has a very bad insight score. And just another quick tip, it shows that the revenue of PPC has been growing 23% the past year, which is obviously strong growth, but the gross margin is 12.74%, which is obviously very low. If we have a look at the profitability of the company, again, its operating margin is 1.64%, meaning that it is only generating 1.64% income from its operations. The net margin is negative, which is negative 9.91, so it is very unprofitable at the moment and it is losing quite a lot of money every quarter. When we scroll to some metrics of the company, we can see that the operating margin is around 5.35% for the latest quarter, but we can have a look back at some of the previous quarters and it just clearly indicates that the company is struggling to improve their operating margin. The biggest problem with PPC is its unprofitable business strategy and it's losing a lot of money every year. Although its revenue is increasing, which might look like a good sign, its gross margin is decreasing. If your gross margin is decreasing, chances are that your net margin is decreasing as well. So with all of this information out of the way, I really feel that you can make your own assumptions and use the information that I shared to determine whether a company is a good investment or not. Some quick stuff that we need to look at is gross margin, net margin, operating margin, and of course, free cash flow. If a company struggles to generate free cash flow, it's a clear indication that it is not a very good business to invest in and it might run into problems down the road. Some other red flags we can look at is the amount of assets versus liabilities a company has. If a company has more liabilities than assets, it's a clear indication that the company is going to run into a few debt problems down the road. This means a company is insolvent, and ultimately, if something should happen, it means that the shareholders and investors will walk away with nothing. This is one of the easiest ways to identify whether a company is in a good financial position or not. So I hope that you guys learned something from this. If it did, consider giving this video a thumbs up and share it with your friends or your family that might be interested in this as well. I hope to see you guys in the next video. So happy New Year's and stay safe.